Right. Let's get straight into it. Dow theory, the big one, the granddaddy of all technical analysis.
Mate, are we serious? My man's gone full history teacher on us. Are we going to be looking at stock tickers on a telegraph machine next? This is proper boomerfy, Chris.
Show some respect. This is the bedrock, the literal foundation of trend trading.
Okay.
You think you're a hotshot trader? You need to know your roots, bruv.
Right.
This stuff is pure CMT level 1 gospel, and it's as relevant today as it was 100 years ago.
100 years ago, they were using horse-drawn carriages for transport.
Yeah, but
We're trading meme coins that rug pull in an afternoon. Come on, man.
listen, the technology changes, but human psychology, it doesn't. Fear and greed are the same. That's what Dow figured out.
Okay.
His theory is built on 6 simple, powerful tenets. So let's start with the one that's going to trigger your inner CFA. Tenet number 1, the market discounts everything.
Okay, I can't even hate on that one. It's basically the efficient market hypothesis with a top hat on.
Right.
It means every piece of news, every earnings forecast, every dodgy rumor about a CEO, it's all already reflected in the price on your screen.
Exactly. So while you're tucked away in a dark room for 3 days reading a 100-page research report, the chart already knows the answer.
Well,
Your alpha is already priced in, mate.
hold up. It's not a waste of time. It's called doing your due diligence.
Yeah.
It's about understanding why the price is where it is. You just see a green candle and a pin. I need to know if the company is actually making money or if it's just a house of cards. It's the difference between investing and just gambling on squiggly lines.
My squiggly lines pay for my holidays, so I'm sorted. Now, shut up and listen. Tenet 2, the market has 3 trends.
Okay.
First, you've got the primary trend. This is the big kahuna, the main bull or bear market. Lasts a year, maybe more.
Right.
Think of it like the tide coming in or out.
The tide. Got it. Simple enough.
Within that tide, you get the secondary trends.
Right.
These are the waves, they're corrections that go against the main trend. A sharp pullback in a bull market or a sucker's rally in a bear market. Lasts a few weeks, maybe a few months. This is where people get shaken out.
The classic buy the dip moment in an uptrend. Or the bull trap in a downtrend. Okay.
Precisely. And last, you have the minor trend. This is the daily garbage, the noise, the ripples on the waves. This is where novice traders get absolutely rinsed trying to long and short every 5-minute move.
Right.
Dow theory teaches you to ignore the ripples and focus on the tide.
So basically, have some patience and zoom out.
Yeah.
Don't get faked out by noise. It's solid advice, I'll give you that.
See, you're not a total lost cause. Now, Tenet 3 is where the real psychology comes in.
Okay.
Primary trends have 3 phases. Let's talk about a bull market. It starts with the accumulation phase. This is when the smart money, the insiders, the VCs, the proper players are buying. The price is flat, boring, no one cares. They're loading their bags in silence.
The get in before it's on Twitter phase.
You know it. Then comes phase 2, public participation. The trend is now obvious. The news is positive. Your barber starts giving you stock tips.
Yup.
All the retail traders who missed the start pile in, fueled by FOMO. This is the longest and strongest part of the trend.
That's my signal. The moment my cousin asks me if he should remortgage his house to buy a coin with a dog on it, I know we're in this phase.
That's the one. Then it leads to the final, most dangerous phase.
Which is?
Excess. This is pure, uncut mania, euphoria. Prices go vertical, valuations make no sense. And this is when the smart money that got in during accumulation begins to quietly sell their positions to the frantic retail buyers.
And then the big flush. So for a bear market, it's just the opposite.
Exactly. It starts with distribution at the top where smart money is offloading, then comes public participation, but this time it's panic selling, and it ends with despair phase, absolute capitulation.
Wow.
Everyone who held on is forced to sell at the bottom just as the next accumulation phase is quietly beginning. It's the circle of life, mate.
It's a perfect map of a market's emotional cycle from hope to greed to fear to despair.
Yep.
You can't argue with that. It happens every single time.
Told you. But now for Tenet 4, and this is where you're going to have a proper moan.
Oh, God.
Indices must confirm each other.
Here we go. This is the bit about the steam trains, isn't it?
Yes, originally, Dow used the industrial average and the transportation average.
Right.
His logic was solid. If the industrial companies making the goods are booming, then the railway companies transporting those goods should be booming too.
Okay.
If they're not moving together, something's wrong.
Bruv, that's ancient. We're in a digital economy. I'm trading tokens for virtual land.
So?
What am I supposed to check the sales of horse-drawn carts? How is that remotely relevant?
You're so literal, honestly. Adapt the principle.
How?
It's not about trains, it's about correlation. Think about the NASDAQ 100 and the semiconductor index, the SOX.
Right.
If big tech stocks are flying, but the chip companies that power them are tanking, that's a massive divergence. That's a red flag.
Okay, I get the principle.
Or, in our world, think Bitcoin and Ethereum.
Okay.
If BTC is ripping to new all-time highs, but ETH is struggling to get off the ground, it suggests the rally isn't that strong. It lacks broad market conviction. That's the Dow confirming principle in 2024. It's about checking the market's engine is running on all cylinders.
Fine, I'll let you have that one. The principle of confirmation is legit. But you have to admit, the railway example is hilarious.
Whatever, mate. 10 at 5 is easier for your big brain to handle.
Oh, good.
Volume must confirm the trend. This is non-negotiable. In a strong uptrend, volume should be high when the price is pushing up, and it should dry up on pullbacks.
That shows conviction.
Yes.
It means the buying is aggressive and the selling is weak. The bulls are in control.
You got it. If you see a price making new highs on pathetic, dwindling volume, that's a huge warning.
Right.
The move is exhausted. It's like trying to rev a car that's out of petrol. And conversely, if you see a small dip that comes with a massive spike in selling volume, watch out. The bears are waking up.
Volume is the fuel.
Exactly.
It measures the emotion behind the move, makes total sense.
Right. Final tenet, number 6.
Okay.
A trend persists until a clear reversal occurs. This is the golden rule. The trend is your friend until the very end. Don't be a hero trying to pick the absolute top or bottom. You'll get slaughtered.
In other words, don't try and catch a falling knife and don't stand in front of the freight train.
There you go. You do listen sometimes. A reversal isn't one bad day or a nasty red candle. An uptrend is a series of higher highs and higher lows.
Right.
For that trend to be officially dead, it has to fail to make a new high and then break below its previous low. You need to see a confirmed change in structure. Until then, the primary trend is still in play.
So let's bring it all home. We've got these 6 tenets from a guy who lived over 100 years ago. Why, in practical terms, does any of this matter for a crypto degen or a stock trader today?
Because it's a mental model that keeps you sane and profitable.
How?
It stops you from panic selling on a minor dip. It helps you understand the character of the market you're in. Are we in the quiet accumulation phase where you should be patiently buying? Or are we in the parabolic excess phase where you should be taking profits off the table before the latecomers become your exit liquidity?
So it's less about a rigid trading system and more of a narrative framework.
Yes!
It's a way to understand the story the market is telling you.
Nailed it! Let's look at that big NVIDIA run. You had the accumulation at the bottom, then the AI narrative kicked in. That was your public participation phase. Volume went ballistic, and then that vertical move earlier this year, pure excess phase. A perfect Dow theory cycle playing out in front of your eyes.
Okay, I see it. You're just applying a structured narrative to the natural cycles of fear and greed, from hope to greed to fear to despair.
Yep.
You can't argue with that. It happens every single time.
Told you. But now for 10 at 5, and this is where you're going to have a proper moan.
Oh, God.
Indices must confirm each other.
Here we go. This is the bit about the steam trains, isn't it?
Yes, originally, Dow used the industrial average and the transportation average.
Right.
His logic was solid. If the industrial companies making the goods are booming, then the railway companies transporting those goods should be booming too.
Okay.
If they're not moving together, something's wrong.
Bruv, that's ancient. We're in a digital economy. I'm trading tokens for virtual land. So, what am I supposed to check the sales of horse-drawn carts? How is that remotely relevant?
You're so literal, honestly. Adapt the principle.
How?
It's not about trains, it's about correlation. Think about the NASDAQ 100 and the semiconductor index, the SOX.
Right.
If big tech stocks are flying, but the chip companies that power them are tanking, that's a massive divergence. That's a red flag.
Okay, I get the principle.
Or, in our world, think Bitcoin and Ethereum.
Okay.
If BTC is ripping to new all-time highs, but ETH is struggling to get off the ground, it suggests the rally isn't that strong. It lacks broad market conviction. That's the Dow confirming principle in 2024. It's about checking the market's engine is running on all cylinders.
Fine, I'll let you have that one. The principle of confirmation is legit. But you have to admit, the railway example is hilarious.
Whatever.